Well, I would say that HCL Technologies has reported an all-round good performance, and also they've gone ahead and hiked the FY21 EBIT margin guidance by 50 bips. They still maintain the revenue growth guidance for Q3 and Q4. Having said that, if you look at the stock is trading slightly soft in trade. The reason being that it had already hit record highs. In fact, the entire IT index had already hit record highs, and we were seeing some amount of profit booking there. Speaking about the results again, HCL Technologies FY21 guidance on the EBIT margin front is now 20 to 21% higher by 50 bips. They maintain the revenue growth guidance in the range of 1.5 to 2.5% quarter on quarter in constant currency terms. If you look at the results, it's a fairly good number. Revenue growth has been at the higher end of their own mid-quarter guidance at 4.5% quarter on quarter in constant currency terms. Dollar revenue has grown by 6.4% to $2507 million. EBIT margin, in fact, has expanded substantially to 21.6%. We at ET Now were expecting EBIT margin of 20.9%. As a result of higher EBIT margin and strong revenue growth, we are seeing a very strong profitability, which has grown nearly around 7.5% quarter on quarter to 3142 crore. In fact, if you look at their commentary on the deal front, well, they've signed 15 transformational deals in Q2. This is versus around 11 transformation deals that they had signed in the last quarter, and these deals have been in verticals like life sciences and healthcare, public services, as well as manufacturing. Their IT services attrition also has come down to 12.2%. It is down by 470 bips on a YOY basis, and they have also generated fairly high free cash flow at 146% of the net income for the entire 12 months trailing September 30th. In fact, it's an all-round performance across the verticals, be it the financial services vertical, manufacturing, telecom, retail, life sciences, public services. But within these verticals, growth was led by life sciences and healthcare, which grew 8.6% QOQ in constant currency terms. Retail CPG has done well, growing at 8.4%. Technology and services, telecom, both these verticals have grown anywhere between 6.1 to 6.3%. Financial services, however, has seen relatively lower growth at 2.6%, and manufacturing vertical, although it has grown 1.5% on a quarter-on-quarter basis, it still has reported decline on a YOY basis. Similarly, even the financial services vertical, although it has reported a growth on quarter-on-quarter basis, it still reports a decline on a YOY basis. Having said that, if you look at the overall segmental performance, well, the IT and the business services segment, which contributes huge amount to their revenues, has grown 4.9% QOQ. Engineering R&D business has grown 3.6%, and products and platform has grown 3.1%. In terms of the mode 1, 2 and 3 performance, again it is an all-round performance. Mode 1, which again contributes significantly to their overall revenues, has grown at 4.3% quarter on quarter in constant currency terms, followed by a strong growth of 6.9% in their mode 2 performance. In fact, speaking about the mode 1 is basically it saw impressive growth, as a lot of digital foundation business is conducted within the mode 1 segment, and also deal pipeline is overall looking fairly high, and clients are strengthening their digital foundation layer, which has contributed to the mode 1 performance. Mode 2 is all about new technologies, and increase in higher value services is going to overall contribute to better margins. Management, while speaking to ET Now, did state that they have hiked the FY21 margin guidance, and also the deal pipeline has come in at all-time high, and they are they are seeing fairly good demand. Bookings, in fact, have increased 35% on a sequential basis. Having said that, the conversion of deals into the revenues takes a few quarters. Both, unlike a TCS and a Wipro, which did declare buyback, HCL Technologies has gone ahead and hiked the dividend per share per quarter. They have doubled it. In fact, HCL Technologies is going to now give dividend of rupees 4 per share per quarter, versus earlier dividend of rupees 2 per share per quarter, and this is in fact going to continue over the period of time, over the next quite a few quarters. Board has also declared pay hikes across the employee base effective from October and January of 2021 and effective of October 2020. Again, at the press conference, management did mention that growth has been led by life sciences and retail CPG vertical. They will continue to invest in new technologies, new geographies, IP portfolio, and also they are seeing many new transformational deals across in many areas. Having said that, manufacturing is still going to take some time to pick up, while they are still seeing very good demand across life sciences, technology, telecom vertical. On the margin front, they did mention that better utilization, cost control has all led to better margins, and engineering and R&D segment also did report handsome margins. In terms of the localization and the impact of the hike of the US visa hikes, they did mention that localization is one of the highest in the industry for them, and 2/3 of the employees are local and dependent on visa, and current US visa regulation hikes there, wage hikes there, probably may have some impact in in the next year, but they do not see it having any impact in the current year. All in all, a very strong commentary coming in from HCL Technologies and a very strong performance with an upgrade to the EBIT margin guidance for FY20.